Okay, time to answer some questions from Sunday's Market Outlook. And somebody had a good idea. I can't believe I didn't think of this before. Is just split your screen. Have your black screen on one side and the questions on the other, and just scroll through. And this way here, you can answer the questions without having to cut and paste. Let's try it out. I'm going through the comment section here. I've expanded all the comments so I don't have to keep clicking back and forth. And it's my first time seeing some of these questions. Some of them I've already seen. Let's see, 49 mark. The earnings yield is not the expected return of the market. No, it is not. Expected return of the cost of equity is likely to be considerably higher than the 5.93%. Well, we say it's likely. I don't know if it's likely to be higher. Though we cannot directly observe the number in markets. I understand what you're trying to say by comparing earnings yield to risk-free, as is popular in the Fed model, but the earnings yield is different from expected return. Yes, it is. If you hold the S&P 500, it is likely priced at the moment to return 8% annually. Is it? Assuming an equity risk premium of 4 to 5% with 10 years the risk-free asset. I see what you're doing here. You are using CAPM. The expected return equals the risk-free plus beta times the equity risk premium. And that's what you would get. If you used the CAPM likes to use a 20-year, so we'll use a 20-year, 3.75. The beta is 1, and the equity risk premium you're saying use 4 to 5%. Why don't we split the difference at 4.5, and you'll get 8.25. This is a long-term, because we're using a 10-year. That's a long-term equity market return. So we would think that if you have a 10-year horizon, that would be your CAGR, your compounded annual growth rate, whereas you could actually experience something like this on the way there, but over the long term you would get that. Here's the deal with this. This is called an equilibrium model. It assumes that the price that you have today is in equilibrium. We can use a one-period model for this as well. For the one period, we can use a one-year rate. Let's put 4.81 in there and add the equity risk premium. We would get to 9.31. And if we assume, if we're using equilibrium models, we must assume that the multiple is also in equilibrium, which is a long-term multiple, forward multiple on the market of 16.6. To get to that level at 16.6. Well, first of all, if we assume the current market 41, I think we're 33 right now, is the March futures. If you put the forward earnings in there, I think actually, sorry, this is the index itself. 41.23 might be the index right now, and you assume that we are in equilibrium right now, you'd need earnings of 248.98. We're not at 248.98. We're at 220.31. So that, assuming 16.6, puts us somewhere around 37.50. And then if you use your 9.31, a one-period model, times 1.0931, you get somewhere around 39.50. Right, and we are not at 39.50. That's the thing with using equilibrium models, is you also assume that the market price is an equilibrium price, and that you can get your expected return from there. But if that expected return is widely shared, the market will be priced up. So it is not true that at any given time that you buy the market, you should expect the 8% over the next year. If you're using a long-term model, if you're using a short-term model, you say 9.31 would assume that you are in equilibrium now, which would assume an equilibrium multiple. So the equilibrium price would be somewhere around 37.50. We're at 41.23. So by that model, this market is quite overvalued, significantly overbought. Using the earnings yield gives you at least some kind of current yield at which you can look at without assuming an equilibrium model at all. And you could say, well, that is the middle of some distribution that you would get, versus a return that is maybe 50 basis points lower that has a tighter distribution like this, right? So then you have to determine, is the step up to the earnings yield here worth the extra possible distribution that you could get, because return comes on both the upside and the downside, right? So there were a couple of questions about that. If you are using a model like CAPM is an equilibrium model. It assumes a market in equilibrium so that you are at fair value no matter what price you are. But that is not true, right? What else do we have? I'm quite familiar with IVP and IVR. With that said, I would greatly appreciate if you could share with the community which implied volatility you are using to calculate those stats. I don't calculate those stats. IB does it for me. You just select what you want shown in your options chain screen, and it gives you that information. It is an at-the-money 30-day implied volatility, the same way that the VIX is calculated. So you have the you've mentioned it in the first term, measuring how cheap or expensive implied volatility is relative to itself is integral to my investment process. Yeah, so I don't do that. I don't think that I've ever entered into any kind of options trade by saying, well, look, the IV on this is mispriced compared to anything else. There are lots of strategies for doing that, but usually most of those strategies will involve options that are trading like at a nickel. Because the model would say that a nickel is simply just too high a price, and it would give this extremely high implied volatility on that option. So you could try to sell it, but which is what you'd want to do, sell that, but you usually find that you have a bid. I can get rid of this stuff on here now. Is on those kind of options, you'll have a bid and an ask, you'll have 0.05, and you'll have nothing over here. So if you could sell them, yeah, it's the implied volatility is way out of line. I don't do those kind of trades. I don't look for that kind of stuff. To me, it's just far too technical and doesn't rely on information other than some mispricing, and it's not my thing. Let's see. Comparable to the Tiff in Greek, Theophanis, usually for men. Okay, well, it had to be something like that. You see a name like Tiff, and you think that it's got to mean something else in some other culture. Let's see. And regarding S&P 500 earnings yield, you compare it with bond yields. You are leaving out the growth component that equities have. Nope. No, I'm not. Remember, growth can be positive, but it can also be negative. If growth was only positive, well, then this would be a much easier world to invest in, right? Let's see. My question for the week are, do you see potential for a stagflation scenario to take hold? Potential? Well, there's always potential, right? So we can say, we talk about possibilities versus probabilities, that, a lot of things are possible, just not very probable. Stagflation would mean that we have very low growth. That is the stagnant part of stagflation, and that we have inflation. I think if we stay to low growth, we could avoid the inflation part. But as soon as you get any acceleration of growth, with the labor market as tight as it is, it's hard to see how you couldn't get inflation. And given today's CPI read and the adjustments that were made for December, CPI going from negative 0.1 in December to positive 0.1 in December. Had that come out in December, it would have shown that the inflation reduction was not as aggressive as everybody thought it was. And January's number is not that aggressive either, when you have core still holding at 0.4. So it's we're not seeing that fall off. So I don't know that you can get. The Fed's going to keep raising rates. I know that. Which will cause the economy to slow even more. And I think they're all of a single mind right now that you are not going to get inflation out of services without getting unemployment up, right? You can get inflation out of goods. Housing, you can get inflation out of rather quickly. Anything that's interest rate sensitive, you can get inflation out of by raising interest rates. But we're not seeing housing give up that much. And I think today I saw a story that new car prices have hit an all-time high. We saw GM just have incredible earnings. Tesla still was able to knock earnings out. So it doesn't seem to have affected that industry, but they were already operating at recessionary levels. So I think that you probably have to go not just 25 or 50 basis points higher, but maybe 100 to 150 basis points higher. You're not going to get it out of the system till you cause a recession. And once it gets into these non-interest rate sensitive areas, how do you get it out, right? Like if it's in labor and raising interest rates, all you can do is raise interest rates to kill the economy, because raising interest rates won't lower labor prices unless you kill the economy, because it's not interest rate sensitive. Possible, yeah. Probable, low probability. I think you'd have a recession first. Do you ever make directional long option bets without getting cash neutral? If so, how do you approach risk management with these plays? Like just buy calls or buy puts? Yeah, I've done that. Without getting cash neutral? When they're working out, I see no point in getting cash neutral. But if they're going sideways, I'm in the money, I'm out of the money, or I shouldn't say I'm in the money, but the options are showing a gain, then they're showing a loss, then a gain. If it's just doing that for a period of time, I will attempt to get cash neutral. Why wouldn't I? Right? Why wouldn't I? I do. And if it works out, great. If it doesn't, well, I'll try to get cash neutral. Is it possible to have a recession with technically low unemployment numbers? If most of the layoffs are happening with high-paying jobs and most hiring freezes are with high-paying jobs, but the low-paying jobs are booming and hence the low unemployment number. But in reality, there's far more consumer damage due to the kinds of jobs that are under pressure. I don't know that it would be classified as a recession if you don't get an increase in unemployment. I don't think that the dating committee would look at that and say, that is a recession. I think they'd say, well, you have the technical footprints of a recession, but it's not a recession. And if you do get unemployment up because the high-wage jobs are going, usually it's the low-wage jobs that suffer first. Not the higher wage jobs. The lower wage, I shouldn't say first, they suffer disproportionately. If it were the other way around, I think there would be a worse recession because you'd be taking more purchasing power per person out of the market with each person unemployed. So I think it would actually be worse. Why not open some short positions on QQQ rather than SPX? You can. It just requires more margin. It's more volatile, which means if it moves against you, it moves against you faster. The margin requirement needed in the futures market is also, I wouldn't say it's higher. Proportionately, it's about the same, but it is higher per contract. But proportionately, based on the notional amount of a short position in NQ is about the same, a little bit higher actually, than a short position in SPY, because the multiplier for NQ is 20, ES is 50. So you can use futures NQ, which has a multiplier of 20, or you can use futures for ES, which is S&P 500, which has a multiple of 50. In Canadian, my margin here is about 18K, whereas here it's about 30. I think it's about 30K margin. So, and it has higher volatility. However, the premium divided by margin is roughly a ratio of about 0.4. Here, rounded, it's about 0.37. So ES, because of its liquidity, is still the most efficient way to get that done, period. And if I want to get higher volatility, I could just over short this one. I could just increase my position, so I don't really need to go to higher beta. I can just take more beta out of the more liquid one. What are your thoughts on investors who do not have much extra time on their hands utilizing funds, ETFs that incorporate options as income factories. JEPCX, that's a mutual fund, right? Or JEPI. Well, they would underperform in a trending market. So if you had a rising market, always selling covered calls on it, these firms, they do not allow the underlying shares to be called away. These are all cash settled. So they'll have their portfolio that they continue to hold, and they'll sell calls. Some will sell 50 delta calls, some will sell 30 delta calls. So the first thing you want to do is determine what delta of call you're selling. And if you have an uptrending market, you certainly want a lower delta being sold. They'll cash settle this, which means they'll take losses. Sometimes they'll have gains if the market does this kind of thing. But if the market does these kind of things, well, you're going to book losses, which means in a trending market, these will underperform. This will underperform significantly more than 0.3. So if you have an uptrending market, you'd want to get a covered call strategy that uses low delta options. And if you feel that you're going to have a sideways market or a downtrending market, then maybe you want a covered call strategy that uses a higher delta. So I would consider the context you're in and then select the strategy that uses the lower delta, but they'll all cash settle it. Okay, where are we? I have a question regarding the CFA in your portfolio management for retail video. You mentioned the benefits of the knowledge provided in the CFA curriculum. The applied series convinced me of its added value and made me want to study for it. However, I was disappointed to learn that you won't get the 3 letters without 4 years of investment decision experience. Is there a way around this? Having the knowledge is the main thing, but the title would be nice to have. It would. I absolutely agree with you and that they do not have an entrepreneurial course or an entrepreneurial stream. So either you are an analyst or you are an asset manager, but what if you were an entrepreneurial investor? In other words, your business, you capitalized your own portfolio and you trade for a living. You invest for a living and you manage a portfolio and it earns. I don't know why they don't have a stream specifically for that if you can demonstrate that that is what you've been doing. I imagine if you could put the case forward that you do this full time, they may have some consideration for it. I mean, if you can demonstrate that that is really what you've done, but I really do think that that having some form of the CFA, okay, fine, maybe it's not the CFA that is more institutional, but maybe some other form of CFA. That is, different. PhDs do this, right? You can take the full doctorate of philosophy. You can take a full PhD, or you can take a more applied PhD, and it's called a DBA, a Doctor of Business Administration. I say DBA because, mine's from a business school, so business schools have the DBA. So this is recognizing that there are some people who would like to get a little bit more involved in research, but more on a practical side as opposed to a purely academic side, more on a practical side. Well, that's what the DBA is for. I think CFA would be well advised to say, okay, well, you have the institutional track down, but what about this large group of people? There are a lot of people who, do this for a living. All day long, they'll do this for a living. Well, what if they pursued the CFA charter? Could they not have the same thing? Perhaps there is a different, kind of like this kind of thing going on. Maybe there is a different designation that suits them. I don't know. I do think that if they did something like that, you could really remove some of the stuff that's in there when it comes to like asset manager code, the GIPS performance, the performance standard, the code of ethics, because, well, it wouldn't really matter to a private individual investor, right? But they may trend towards that. I don't know. Do you think holding a short position and getting the cash yield or stepping into a costless synthetic short would be a smarter way to play the expected market weakness? Well, if I have a costless synthetic short, I basically have a cash, a spot market short. if I use futures to short the market, because I'm shorting at the future price, not the current spot price, I do have positive carry. I'm not sure what you mean holding a short. Oh, I think I know what you mean. Holding a short position. So I'm going to sell SPY, and when I sell SPY, 100% of the proceeds are deposited in my account. This will earn a cash yield. You're right, that will earn a cash yield. So I do have some positive carry in that sense, but I do have to hold another 30% as margin against that in cash. If you're holding a costless synthetic, you're still going to have margin. You still need cash margin for this, because you're going to have one of your options being a short position. The most efficient way of shorting the market is with futures and even options on futures, especially ES. It is the most capital efficient way to take a short position, especially with interest rates as high as they are, because you get that carry. I would think that it makes sense to invest in US large caps passively. Do you think for other strategies, emerging markets, domestic, mid cap, it makes sense to try to find good active managers? I think you got something there. Large caps, it's hard to generate active return or alpha in large caps, because they are, if you're going to measure the market in terms of efficiency, I don't know that it makes sense to say the market is efficient, but I would say certain parts of the market are more efficient than other parts. Large cap stocks have such broad analyst following that they are as close to efficient. If we buy into efficiency, it's as close to efficient as you're going to get. So I think it would be hard to generate alpha in large cap markets. So yeah, passively can make sense. Small cap, I think, is, it depends on how much you're paying for active management, right? The hope is that they can outperform the benchmark, but over multiple years, very, very few actually outperform the benchmark. That if you were playing the probabilities, you would never use an active manager. If you were playing the probabilities, unless you can find an active manager that is not constrained by a benchmark, in which case you're going into hedge funds. So if you're going into active management, into a fund with active management, and they have a benchmark, most of them don't make it. Most of them don't beat the benchmark over a period of 4 or 5 years, will not beat their benchmark. Most of them underperform. So you'd want to be benchmark agnostic, which means you'd want to go into hedge funds. And what about fixed income space? Well, it also depends on what they're doing. If it's treasury portfolios, I don't know that it's worth active management there. Probably passive. If it is credit, a credit-based portfolio, probably credit meaning corporate bonds, probably. If it is, other types of bonds like, asset-backed securities, things like that, you probably would want more active management, because they can bring a lot of leverage to it as well. They hedge out the interest rate risk, they isolate the credit spread, and then they lever it up. It seems to me that the Fed's open mouth operation style has changed. Yeah, you could say that. They don't feel urgency to convince or scare markets about future rate hikes anymore. Why is that? Well, I think it's probably becoming hard for them to keep denying that inflation has been coming down. It has. So I think it's okay to pat yourself on the back and say, look, the job is getting done. We said we're doing it. But they do have the hard task of, not just telling the truth, but understanding that if they say something, what impact will it have on market participants, who will then have an impact on the market, who will only make things harder for them. So yeah, I think they got a tough job here. Do they still see upside risk for inflation and think markets will adjust themselves? Yeah, I think they still see upside risk for inflation. I think January's CPI read that we got February 14th sort of confirms to them that, the easy part of the fight is over. Now it's going to be the long, hard part of the fight, getting it down from 4.5 to 4.8% down to 2%. That's, getting it from 9 to 5 was easy. Getting it from 5 to 2 is going to be long and hard. I think they recognize that. But we get the minutes next week, so we'll find out what they think. If that is the case, and given that they already have minimized rate hike sizes and want to give their time to their policy, can we say TIPS would be a better hedge than nominal bonds in the current environment? If we're thinking about a hedge for inflation and you look at the break-even rate, let's say on the 5-year or the 10-year, and you think inflation will be higher than that break-even rate over the next 5 years, then TIPS would be better than nominal. Yes. I believe you have sector analysis section in your applied series course. Would the sector analysis only apply to U.S. markets? Well, not really. When you analyze a sector like consumer discretionary, a consumer discretionary stock is a consumer discretionary stock in any market. I'm using XLY, which is an ETF based on the S&P 500, to make my point about consumer discretionary. In a different country, there might be a different ETF with different stocks in there. And the consumer discretionary sector may have a different weighting in that country than it has in the U.S. It may not be as important or may be more important. But the underlying thesis behind how consumer discretionary acts in different parts of the business cycle would remain the same. I live in France but plan on moving back to Sydney. Won't one sector differ from one country to another based on different market regulations? Not really. They differ from one country to another based on how important that sector is to the economy. For example, Australia's market index, if you look at the sectors of the economy there, materials and mining are significantly greater in Australia than they are in the US. Like, I think 3 times bigger. And I think that it's even bigger than in Canada. And Canada is pretty heavy on minerals and mining. But Australia is even bigger on that. Australia would have the same, BHP. I think has the same, prospects in the market as any other mining company anywhere else in the world. So I don't know that an analysis of that sector would be any different if I were in Canada versus Australia. The only difference between them is it makes up a significantly bigger part of the economy in Australia, that it's hard to be an investor without bumping in to that sector at some point because it's just so large. Whereas in the US, I think it's like 6% of the economy. But in Australia, it's something like 18, 20%. I think somehow I got a number of 24% in my head too. It is quite big. I have a negative CAD balance on IBKR. I bought Canadian securities and did not convert currencies. Yeah, you'll get a negative balance. Do I pay the interest rate for cash on negative balance? Yep, until you cover it. Yep, you do. Yep, you do. When you say Mexico would not fare well in a global recession, I didn't say that Mexico. I said the Mexican peso would not fare well in a global recession, simply because they are still a manufacturing economy. It's because the currency is not considered a safe haven currency. So if there's a global recession, you want safety. Your money is going to run to safe havens. That would be Switzerland, that would be Japan, that would be the US dollar. Mexico is not considered a safe haven currency. Plus, the currency is too small. And if the currency is too small, it's not going to handle a lot of inflows without going up quite significantly. So in tough economic times, central banks, especially in developed economies, central banks really cut interest rates. So their bond market would rally significantly, which is why it draws all that money in at the same time, because, hey, I'll hold government bonds and I feel pretty safe. But in a recession, maybe certain economies might not, their government bond market might not be the safest. Even if they are, they might not be perceived that way, and Mexico is not known as a safe haven currency, so it wouldn't fare well. I personally expect CPI to pick up for the following reasons. Price of gas has been going steadily up in the last few weeks. We had a significant spike in PMI services, which I would expect would translate in higher prices on core services. I think we're still within the 12 to 18 month lag effect of rents going up. Yeah, we saw housing continue to climb in the CPI report that we got today. And services ex-housing hasn't shown any improvement at all. So the base effects should start to come off. April, May, you'll start to see the base effects wear off. But we are, year over year, like 450 basis points higher, and it's not having an effect. So you have to stop and say, well, listen, it's been a year and it's not having an effect. In fact, it's quite solid in there. It doesn't seem to be showing any kind of reduction from where it is now. So yeah, it could be a tough fight in there, so that it would pick up. If you get any acceleration of growth at this point, yes, you're absolutely right. I think so, and that's why I maintain a short on the market, because rates will only go higher if that happens. How long does it typically take for rising oil prices to reflect in cost of goods? Well, shipping right away, pretty much right away. And for a large read like we had in the PMI service to reflect in the service section of CPI. Well, inflation happens at the margin, right? It's the very next thing that you buy or the very next person that you hire. So it tends to show up pretty much. I wouldn't even say that it shows up with a lag. It tends to show up when it shows up. It's when it disappears. When we say a lag, how long does it take for rising interest rates to stop that level of inflation? That's what we mean for a lag. But there are times where costs increase, input costs increase for a company, but they don't increase their prices to their customers because they think, oh, this price increase is transitory. That might have happened early last year where costs were rising, and some companies might have just been saying, well, there's no point in adjusting all our prices. We might be uncompetitive if no one else adjusts their price. We'll just wait and see. But now I think if, after a whole year, when you start seeing your input costs go up, you're more likely to assume that it is part of the trend and not transitory at this point, which means it would tend to show up faster and sooner. There is the comment about split your screen. Let's see. Can you please explain why you think fair value of S&P 500 index is between 38.50 to 39.50? And I think I did earlier using that example of the equilibrium model, that if you assume an equilibrium, 220 at a 16.6 would put you to 37 and change. That if you applied the long-term or even a 1 year cap M to it, you get to around 39 and change. So you're about 37.50 to 39.50. Very much in agreement. Higher rates imply lower valuations, imply the market should not be reaching all-time highs when the prior cycle had 0.25 to 0.2 rates in models. Currently of the opinion this is short covering rally. Yeah, because it's not showing conviction really. I mean, the volume is lackluster. Let's see. F18.3, where can one get the rate for F18.3? I just put a video up today which is a tutorial on the interest rate components of the market update. So I go through the nominal rates, real rates, break-even rates, and I show you where to find the forward rate F18.3 using Chatham Financial. They do a good job of consolidating data. You can always get it from the CME. You can always look it up yourself, but Chatham Financial on their site, when you click on forward rates, they graph it all for you. They have the algorithm that aggregates the data and graphs, and I think, well, this is good. Why should I do it myself? You guys are doing it for me, and they're using CME data, so good enough. So I will direct you to that. Let's see. It says here 3-month nominal yield as shown in your spreadsheet is 4.79, but use 4.76 because I'm using a proxy for the 3-month rate. I'm using the secured overnight funding rate, which should track very closely to the 3-month Treasury. As you can see, 4.79 versus 4.76, it tracks very closely. So I'm just using it as a proxy. What is the impact of rising or falling interest rates on your futures position? But what impact does that have on your expected P&L? If interest rates go up, the carry goes up. But it doesn't matter. It does not matter what happens to that, whether the carry goes up or carry goes down. In my P&L for the day, it'll show that, yeah, on the mark to market, either I made or I lost that day. There might be some cash flow adjustments in terms of the mark to market that needs to be done. But it wouldn't matter if the futures price goes up because interest rates went up. Yeah, it would show. If holding all else constant, I would have a mark-to-market loss for the day by the difference, but it wouldn't be much. It really wouldn't be much based on how much time is left in the contract. It wouldn't be like it's a 50-point adjustment. It wouldn't be anything like that at all. But it wouldn't matter to me because the only thing that matters is the spot market, is the cash market, is where is that versus where I am, because I know that carry will decay every single day. That if I'm willing to hold all the way to expiration, that carry will completely disappear. So if I'm looking to meet the cash market at some point in the future somewhere, all I care about is the cash market. In your case of being short a futures contract, if Fed sounds dovish, the value of carry would go down, which is good for you. Not really. If Fed sounds dovish, it's not just the value of the carry that would go down, the equity market would go up. And if I'm short the futures contract, the directional move of the underlying is far greater than any carry that I would get over the course of the day. Also, a dovish Fed would cause the S&P index to shoot up, which is bad. Oh, you did finish it. I should have kept reading. Yeah, no, you got it. But the index, the bad, is really bad. Whereas the good is, it's a little bit good. But the bad is really bad. Okay? Could you please tell us the web address leading to the download site of S&P Global EPS fact sheet? In the description box, I even have it labeled linked to spreadsheet. And it is the same. It is in the same place every week, so you just have to bookmark the link. I explained the math and thinking behind the earnings yield. Already did that. Value factors tend to outperform in recession. Maybe that is the reason behind Europe outperforming U.S. recently. I think the reason Europe has been outperforming is because it was discounted so much because the thought was, it's going to be really bad. And seeing that it isn't as bad and that the spillover from Ukraine really is not spilling over into other countries. And I had said last year that the longer this goes on, this war in Ukraine, the more the market will just ignore it. It'll just become part of the background. And that's really what's happening right now, is it's really just part of the background. It's not as if, oh my God, this is terrible for markets. It's like, yeah, that's going on, but so's a whole bunch of other stuff in the world. So that's going on. The world is adjusted. That is the issue right now with that, is the longer something goes on, the more companies adjust and move around the situation. They reestablish suppliers in other areas, and then it just becomes part of the background noise that doesn't really affect much. Europe and U.S. have very different tax laws. Tax rates are higher in Europe than they are in the U.S., and because of that, the use of debt is more prevalent in Europe than the U.S. because of the tax shield. The cost of debt in Europe is extremely low because it has a higher tax rate. Right? So if you think about your cost of debt, it is RD1 minus the tax rate. Well, the higher the tax rate, the lower the cost of debt. If you look at capital structures in Europe, they tend to have more debt than capital structures in the U.S. So there is, if you're looking for growth prospects, I think they happen in the U.S. more than they would happen in Europe. But I don't know so much that it was value outperforming as much as the market was oversold to a point that wasn't justified. But I don't really know for sure. I don't really follow any of the markets. I believe I heard the UK market is hitting all-time highs, which to me seems odd. But since I have no vested interest in those markets at all, I don't really pay attention to them. I couldn't even tell you where the Canadian index is. I mean, I'm not kidding you. I don't know where the Canadian market is. To save my life, I couldn't tell you if the Canadian index, if the TSX is above its high last year, below its high. I couldn't tell you anything. I couldn't tell you the earnings multiple. I probably couldn't name 10 companies in the index. I probably couldn't name 5 well, I'd name the 5 banks or the 6 banks and a couple of utility companies. I'd probably be right, but beyond that, they'd just be guesses. I really just understand one market. So I'm Canadian, and I don't even know what's going on in my own country in that sense. Curious to hear your thoughts on a comment that I heard from Jim Chanos. He said, one of the most mean reverting time series in all of economics and finance is corporate profitability. We talk about how expensive market currently is. Well, that is true. The long-term mean reverting level is 6% of GDP. That corporate earnings represent roughly 6% of GDP. But for the last 15 years or so, that hasn't been the case. Now, that might be due to the sheer amount of liquidity introduced into global financial markets from central banks all around the world. And that really accelerated in 2008, 2009. It might be due to that suddenly we're running around 11.5, 12.5% of GDP, double the mean reverting level. That if it did mean revert, that's a long way down for earnings as a share of GDP. But yeah, it is mean reverting. It has been mean reverting for a long period of time, but not for quite some time. Now, it just may be at a new mean reverting level. It could be that the 6% mean reverting level was pre-China entering the World Trade Organization, and that the new mean reverting level, because of the increase in margins you get by outsourcing everything to China, you're not lowering your price, you're just increasing your margin when you send work to China. The new mean reverting level could be 10%. So that if we're at 11.5, 12, we're not that far above the mean reverting level. There could have been a regime change. Because if we do look at Fred, and this is on Fred, you can see it running around 6, and then it started to do this, right? And we've been up here for quite some time, whereas typically, if this here was 6%, now we're up here, more near the top end of this range over here. So is it going to mean revert to 6? Is this going to disappear? Or is this basically here a regime change? And if it is, what exactly can we tie to this to say, well, what was it specifically that resulted in that change? That's for an academic to figure out. Let's see. In your applied series, you mentioned about the Fed potentially selling MBS in the future. How do you think this action will affect mortgage rates? You did mention the Fed will lower rates before selling MBS because they don't want to take a loss, but they will be able to do so if inflation stays elevated. He was asked about selling the MBS, and he said that there are no plans at this point in time. No one's talking about selling. He says, but to have runoff in the MBS sector because it is so significantly high, that yeah, they would at some point have to sell because runoff wouldn't be fast enough. But that they are nowhere near discussing selling at this point in time. And if they do want to sell MBS, they will telegraph that quarters in advance, 2, 3, 4 quarters in advance. They will telegraph that. And I think if they do want to lower their MBS position, I think they would wait until the valuations of whatever they're holding go back to the level that they paid so that they don't have to take a loss on them. They're going to try to avoid doing that, but they are a long way from selling, so I wouldn't worry too much about that. What are your thoughts on the January CPI report, and what do you think of the market's reaction to it? Market's reaction to me was absolutely curious. As soon as it was released, I was watching the S&P chart, right? And the market was doing this, and then it came out, and you had a red bar that did this. And I said, I saw the numbers, and I thought, well, that's the right reaction. You know, the next bar did this, then it did this. And up it went. I was looking at the December ZQ, which is the Fed Funds Futures for December. It was at 94.985. And it rallied all the way to 95.13, up 14 basis points. So that's the market saying, oh, great, a rate cut's going to happen by December. The U.S. dollar crashed. Oh, rates higher for longer. Let's sell the U.S. dollar. Let's fight the Fed over here. And I looked at this and go, you've got to be kidding me. Well, are we at this again? Is this really what we're doing? And then it did this. And I said, that makes a lot more sense. Then it did this. And I thought, oh, are you kidding me? Anyways, I have no idea. But somebody had a great quote on Bloomberg today saying that the CPI report allowed everybody to keep their views about inflation that they had before the report came out. That if you thought inflation was coming down, this report gave you something to believe. If you thought inflation was going back up, this report gave you something to believe, so that it changed nobody's mind. And you had this kind of reaction, but it was, usually I'm very calm, but when I saw this going on, I saw the US dollar selling off, I saw ZQ going up, I saw bond futures rally, yields dropping, I thought, you must be kidding me. This must be wrong. Or I'm missing something so obvious that I'm terrible at this then. It's time to retire because I haven't got a clue what the hell is going on here. So what was my reaction to it? Total confusion. Looking at it going, okay, I give up. I have no idea what this is doing right now. None at all. None of my hedges were working. Every single hedge I had was working against me. So I leaned into it. I did more hedges. And then it did this. And then that's where I calmed down and said, oh, hang on a second. This is not the universe screwing me. This was the universe giving me a chance to double down on my bets. This is the universe paying off. And then the universe screwed me again. I said, now this is the universe screwing me. Because they did this just to sucker me in up here, and then did it again. When you see something like this going on, all you can do is just look with amazement at the screen and go, what the hell is going on? I don't know. It was the weirdest reaction that I've seen. Maybe it'll be one of those delayed things that, we'll get retail sales tomorrow. It'll be weak, and then everyone will say, you know what? Yesterday wasn't that great either, was it? And earnings haven't been that great either. Maybe we're in the wrong room, and maybe they'll, let's see. You should consider looking at earnings yield to 10-year of the Fed funds historically. There have been many instances in history for which the earnings yield was lower than where interest rates were. That's true. When if markets are extremely overvalued, you will have a very low earnings yield. That's the point, right? Periods of time that lasted 5+ years. Yeah, I agree. You are taking a non-fixed numerator and comparing it to a fixed return. Well, that's the point. That's exactly the point. That's what you would do, right? Is you're taking a return that has a distribution and comparing it to a return that has no distribution and saying, okay, this return has a distribution both to the upside and to the downside, and that this return is only a few basis points above this other return that's positive that has no distribution like that. That is the point of doing that. That's exactly the point. Obviously, there are risks that E drops over the next 12 months. They have been dropping, yes. I don't know. I feel like conceptually it is incredibly easy to make the bear case that literally every single macro analyst is predicting. I feel as though you do a good job showing both sides. Oh, no, that's a compliment. I'll take it. Biggest thing to remember is that following bear market troughs, the market always multiple expands by an average of 4 to 5 points. That is true. They always do. Because earnings are low and the market will price in a better future. That is very true. However, usually that happens when inflation is pretty much gone, unemployment is high, and the economy has contracted. We don't have that. We have earnings still coming down. Earnings, from a high level still coming down that are still considered high, and a market trading at a multiple over 18 right now in the face of rising interest rates. So every time that you've had that multiple expansion coming out of a contraction, you did not have a multiple expansion into a Fed that was raising rates. That's the big difference today, is that you have a Fed that you're if you think that, well, this could be a multiple expansion before the bull run, you do not have a setup for a bull run in the face of a Fed that is still raising rates from an already high level. That's the big difference here. Okay. If we sold June ES put at 40.50, that's low. And at the end of the contract, if we do not close by 9:30 a.m., we would have the full notional value of the contract in the account, correct? No, you would not. These are marked to market. Every single day they're marked to market. So here is what would happen. Let's scroll all the way to, this is June 16th, and here is June 17th at 9:30 a.m. That is when the contract expires. June 16th, there's a settlement date. There is marked to market. If you're in gains, you get money in your account. If you're in losses, money leaves. The next day at 9:30, it expires. You only have to settle up of the difference in the price for those 2 days, because every single day, if we go back, as you go every single day, you settle up. Every single day you settle up. That's the mark-to-market process. If you're in gains, you get money in your account that day such that you are even now. Or money leaves your account such that you are even. Every day you are even and flat. You've already realized your losses. So the only settlement that happens is, what was the settlement price here? What did it close and settle at here? Then this final mark to market happens, and whatever margin you have is then released. And this is just canceled. So no, it wouldn't be the full notional amount of the contract, just the mark to market for the 1 day. Let's see. Or we can just close the contract on that Thursday. You'd have to close it on Thursday. Well, you can close it at 9 o'clock on Friday morning. You have all the way to 9:30, but liquidity drops really quickly by the time you get to Friday morning. Liquidity drops really quick. So if you want to close it, do it the day before Thursday and sell the following month futures at 40.50. Oh, I see what you mean. Your strike price is at 40.50. I see. Okay, you're not your strike. Sorry. You can't just sell the following month at 40.50 unless you're hang on, let me read it again. You sold a put at 40.50. Yes, you can roll your put over. So if it is a put, yeah, you did have the mark to market here. The put would be exercisable into the ES contract, and then the ES contract would be cash settled. Cash settled meaning just the difference, but you can roll it to the next month. Yes, you can. You can do that. If we are to be assigned the underlying otherwise. If you're assigned the underlying, it is for half a second, because you'll get the underlying and then the underlying will immediately cancel. I think I explained that well enough. I got confused between the contract, the short contract, and the put. You were short the put at 40.50. Okay, I get that. You said you like to close your options a week before expiration to not have gamma risk. Can you explain gamma risk again? All right, so gamma risk is the risk associated with the underlying moving, right? So the closer you get to options expiration, let's say you have let's draw this out here. This will be a delta of 1, and this is a delta of 0, and this is the stock price. And let's say that this is expiration up here 60 days away. As the stock price moves, you might do this on your delta, right? And as it does this, you might do this as it does this. I'm assuming you have a call here. But as we get close to expiration, as it does this, this is what's going to happen. Is if your strike price is over here and the stock price is just, it doesn't have to wiggle much in front of the stock price, especially the last day, your deltas will run to 1 or 0, 1 to 0, 1 to 0. The volatility will really start to spike. That is your gamma risk right there. Gamma increases, which increases the rate of change of delta. So on the last day of options expiration, if the price is around a particular strike that you happen to have, and it's, like in the last hour, you're 5 or 10 cents below the strike price, you'll have a delta close to 0. If it goes above, it'll zoom to 1, it'll zoom to 0, zoom to 1. You'll have all of this gamma risk going on. And it starts to increase in that final week. You'll start to see this going on, especially if you have options near a strike price, as you get a lot of that gamma risk going on. So most income traders, if you're using options for income, will have a policy of saying, look, I do 30 to 45 days to expiration options, but 7 to 14 days before expiration, I close them out, just to avoid a lot of this stuff going on. Let's see, if your 40/50 put on futures would be assigned to you at the end of the contract, since you collected the premium 122, you would be buying at 39.28 effectively, right? So you would actually own SPX for the full contract value. No, they're all cash settled. There is no delivery of the underlying, they're all cash settled, but my effective put price would be 39.28, but it would be cash settled. I'm just trying to picture what you would end up being assigned. Nothing. Nothing. Typically, you would, if it's out of the money, you just ignore it. If there's something that you're underwater on it, you're only underwater for 1 day, because you're marked to market every day. So really, the most you can lose by letting it go one more day is 1 more day's worth of move. But maybe you don't want to do that. You'd know in advance that you're going to roll it or that you're going to close it. Regarding your comment on equity market not getting a message higher for longer, is there a possibility? Is looking past the next 2 years? Why go down if it will go up? Well, if we use that argument, why would anything go down? Why would house price ever drop in value? Because if you go out 20 years, they'll only be higher. The market sold off last year. Well, if we looked past the rate hikes and inflation, saying, well, they'll eventually get inflation under control and we'll eventually have another bull market, why even go down? I would love a world like that where asset prices either go flat or up, because then I could just buy and go away. It would be an easy life at that point if prices didn't go down, but they do. So the idea of why go down if it will go up, you could say that with anything. Why would the price of anything go down if it's only going to go up? But they do. Could you remind us of where you get the forward 1 and 2-1 rates from? It looks like Chatham Financial. No, those are calculated. If you look at the video I put up today, the tutorial on interest rates, I show you exactly how to calculate each of these 1-year forward rates. Jonathan Farrow, Tom Keene. I like Jonathan Farrow. When he does an interview, this guy doesn't pull any punches. I mean, he asks tough questions. He's not afraid to ask the tough questions. You know who's great at interviewing, who's not afraid to ask tough questions? Bill Maher. If you ever see him interview anyone, usually at the beginning of a show, Real Time with Bill Maher, he does a little opening monologue comedy thing. Then he interviews somebody, for 4 or 5 minutes. He doesn't pull any punches. He's had some pretty important people sitting across from him there, and he asks the uncomfortable questions, and he's not afraid to speak his mind. I like people like that, who don't just softball something or are afraid of the person they're asking questions to. He was on the interview today with the Richmond Fed President, Barkin, and he asked Barkin some uncomfortable questions. Go on YouTube, see if you can find it. Bloomberg Barkin interview February 14th, and you can listen to some of the questions he asks, and he's good. I like that guy. But yeah, are there any other sources on market sentiment you can recommend? I don't like listening to a lot of stuff, only because it's I have listened to other people, and I always do. You know, I scan YouTube and I say, I've never heard of this person. Let me listen to him. But then I'll hear something said where, no, hang on, that's wrong. That's not true. And then, no, hang on, that's not true either. You know, these things aren't true. So I stop listening because I think, well, okay, you have an idea of what's going on that you're sharing, but it's not rigorous. You're making mistakes in what you're saying. Princeton has a good site. I shared that before. Marcus Academy, Markus, Marcus Academy from Princeton. I think he does one a week with some really high-end people, really intelligent people with well thought out research that present their research. I like those. Those are really good. They're very thoughtful because it's not somebody trying to convince me to buy something, or not somebody trying to convince me that markets are going to the moon and you should have diamond hands. And it's not somebody talking nonsense like that. It's all good stuff. What do we got? Why is the market so concerned about what Powell and Brainerd think? Because he's the chair and she's the vice chair. That's why. The chair pretty much gets his way because before the meeting, the chair usually has a conversation with everybody one-on-one. And in the interview on Bloomberg that we saw earlier in the week, or I think it was last week, he said that when they come to the voting of what they want to do, he speaks first and he says, here are my thoughts. Here's what I'm leaning towards this kind of hike. And usually, unless you really disagree, you usually fall in line because you've already spoken to him before. You've already come to a consensus. He's a consensus builder, so what he says has a lot more weight. Same with the vice chair. Doesn't interest rate component decay linearly over time, only when yield curve is flat or constant? No, interest is linear. I did answer that down there. Does higher cost of capital impact big tech companies who are sitting on cash war chests and don't know what to do with it already? It would seem to impact poorly capitalized companies more heavily. How does this impact S&P 500 when it's so tech heavy? Well, you're not buying companies because they're sitting on cash, right? I mean, cash gets a cash rate. You can get a cash rate on your own. You're not about to buy equity and be last in line in the capital structure just because a company has cash on their balance sheet. That's not why you're buying the company. And the cost of the equity and the risk of the equity and even the cost of their corporate debt, if they have debt, the cost of their debt is going to be higher than the cash rate they get. So it's not as if they're a money-making machine because they sit on cash. That's the lowest form of return the company can get. If they're just going to sit on cash, they should either return it to shareholders, make an acquisition, or invest in expansion. But please, let's just not sit on cash, right? I have a question concerning the AS fees. It's not clear. Is this a recurring fee or the applied series? No, it is not a recurring fee. I did answer that. What the data interval means for 320, which is until February 28th. Well, the thinking was that as I released each section, the price would eventually increase to the full price, but I think we're just going to hold it at 320, and I'm just going to continue to add content in whatever folder I think makes sense that week to add content in. Yeah, that's all I'm going to do is just keep filling it out, and every week or 2 weeks throw a video in. So over the course of the year, 25, 30, 35 videos will go in, and you pay a fee once, and that's it. It's done. I had different ideas when I started, but as you start, you always have an idea of what something's going to look like when you begin. But as you start working on it, you say, yeah, you know what? It doesn't fit with where I'm going, and you modify, you change. And so as long as you're not taking away the value you promised, but increasing the value, who cares? If you tell someone, look, it was here was the price for a 3-year subscription, and then after 3 years it's archived. If you change it and you say, you know what, it's not 3 years anymore, there is no expiration. Well, you've added value without charging them for it, right? What you don't want to do is change your mind and remove value after somebody buys it. But at this point, that's what it is. What I'm trying to do with the Applied series, just so that you know, is I'm trying to create And I don't want to say a whole new level to the CFA because the CFA Institute may have an issue with me saying that, but I'm trying to create something that would be considered an applied level. That after you've gone through level 1, 2, 3, it's like, okay, I got all this book knowledge, but honestly, I've never seen a curve steepener trade. I've never traded the Fed funds futures. I don't know how to trade a curve, a commodities curve that's in backwardation. What are the you may read about it and you're familiar with the language, but you've never actually seen it done or have done it. This is what this applied series is supposed to be. Is supposed to be the practical level to the CFA program. I don't think the Institute would like it if I called it CFA level 4. But I can't stop the conversation on Reddit if Reddit wants to call it that. If people on Reddit want to call it that, I can't stop that. That's out of my control. I'm not calling it that, but if somebody does call it that, well then that's what it's... I got to be careful here. Joke's on you, Mark. Some of us are gay. Okay, I don't know if I made a gay joke. And if I did, I'd like to know about it because I don't have any gay jokes. So I'd like to know which one, what I said that was a gay joke. But okay, maybe it was about everybody's watching football and not watching this. But do gay people not watch sports? I don't know. If you're listening, tell me what I said that was funny or that was perceived as a joke. Let's see. As someone who dumped cash in more volatile sectors last week, I might have to reevaluate. I get some of these where it goes ... and I've clicked on show more. Now it says show less, but I'm wondering, was there more and it just got cut off? I don't know. Let's see. When you say 10 a year up 14 basis points, where's that? Oh, I already answered that. That is going to the yeah. You can click on reply, and I already answered that one. It was just a small issue there. This one's asking about trading crypto. If you've listened to me for any point in time, you know that I have no belief in this stuff at all. This is purely just gambling chips on a table. If you're playing with crypto, that really is all it is. It is a tool for money laundering and criminals, and when it's not being used for money laundering and criminals, it to me is the same as going to the blackjack tables and betting, or the roulette wheel and betting. It has no value other than its gambling value. That is all it is. I would say that in level 1 we learn about different perspectives on risk from individuals: risk averse, risk seeking, risk neutral. That if you're in crypto, you are a risk seeking individual. You're not risk averse or risk neutral. You are truly seeking out risk, and you're looking for the riskiest thing to play because it gives you something. I would not touch that ever because, well, this is not a casino for me. This is a business, right? So I wouldn't touch that. Household debt, look at Sweden. Yes, but do you have maple syrup, right? Let's see. I live in India. I can't seem to find these Fed speakers on YouTube. Where can I listen in? Sometimes they're just not on YouTube. Sometimes they're talking somewhere at some conference or some luncheon or some business symposium or some chamber of commerce meeting that they're attending. They all speak within their districts, right? That sometimes it's just not available on YouTube. You can go to each of the different sites, like the Richmond Fed, St. Louis Fed, Atlanta Fed, and you can look at, they should have a section of who's speaking when. Sometimes they have the transcript available after. Sometimes they have the video available after. I guess it would be a good idea to have, if somebody was good at coding, to put up a small little site that aggregated all of the content every single week, saying here's the new video content or speech content that was added just this week. I don't know, something like that. Let's see, and that is it. Is the applied series paid content? Yes, it is. So what's the play? You should do it too long, didn't read at the end. No, because this is really about trying to give you the tools so that you can start making your own decisions rather than outsourcing your thinking to other people and having people say, buy this, sell that. This is far more on the education side and far less on, hey, here's a list of 10 stocks that are flashing buy signals. And if you just subscribe to my site, my proprietary software will tell you what. That is not what this is. It really is more about, here are the tools that you can use and develop such that you don't need to listen to other people tell you what to do, that you will develop the skill on your own so that you will know what to do. Unfortunately, education has no TLDR. It just doesn't. You have to put in the time. That's the nice thing about it too, by the way, is you have to put in the time. Now think about that. Many people are unwilling to put in the time. That gives you an advantage right there. If you're willing to put in the time, most people aren't. So that is the nice thing about education, is it is a small club. The more educated you get, the smaller the club becomes, because most people are not willing to put in the time. There we go.